Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Younger investors should get expert financial advice from a fiduciary that is licensed and registered like a registered investment advisor. Overtaking financial advice from a non-expert or a stranger on platforms like TikToks. Joining us for Financial Literacy Month, we have Jason Wenk, CEO of Altruist, a modern custodian for registered investment advisors. He joins us to discuss, I don't know, those could be fighting words, Jason. You're telling a young person, don't go on TikTok, but after the volatility we saw in March, person-to-person advice might be warranted here. Before we get into that, let's talk about Altruistas Mission and how it relates to financial advice.
Absolutely, yeah, glad to. So we started the company to make financial advice better, more affordable, and accessible to everyone. And yeah, you shouldn't have to get that from TikTok, with no offense to all the FinTalkers out there. There's lots of really amazing, talented people in incredibly diverse backgrounds that, are eager to help people solve their personal financial problems. And it's just actually hard to find them. So I think that's a big challenge. Hopefully this month makes it a lot easier for people to figure out where to find those people. And Altruist helps empower those advisors to do great work.
Yeah, and to my point off the top, when you have the Federal Reserve rate hikes, inflation, we had the crisis of confidence in the banking system. Perhaps that does serve as a good reminder that maybe not even just going towards a TikTok or a finfluencer or an old school type of advisor. Perhaps there's some middle ground there.
Yeah, look, I think in times like this, it's very common for people to get confused. I actually spoke with someone this morning that was spending way too much time on YouTube, and they've learned every conspiracy theory about why every bank in America will fail. Look, there's great information on these web platforms. So pick your favorite social media platform. There's great people sharing great information. You just have to kind of keep in mind that there's also an absolute mountain of really bad information out there. And there's probably nothing that could be said in a big, large public setting that's going to be personalized and individualized, right, for someone's unique situation. So this is why it's so key to actually find your person, like the person you can count on, trust, work with closely and collaboratively, share your deepest ambitions and fears, right, and then get some guidance. But in this last few months, I think the volume of people experiencing financial anxiety went up significantly. For better or worse, that drives people to places to seek out, some comfort. And again, there are some good, honest people out there doing that work. There's plenty of charlatans too. It's got to kind of know which ones are which.
Right. And then also you have the propensity on social media to kind of follow the people that hold the same views as you, because it is really challenging from a human perspective to maybe not hear what you're looking to hear. But this is a good time to talk about this, Jason, because younger generations in the US are poised to inherit trillions of wealth over the next few decades. How do you think they're going to handle that money?
Yeah, I think a lot different than their parents, right? So when we think about young people today, I think the statistic I heard is like 30 trillion over the next 20 years. It's a huge amount of money that'll be transferring generationally. Look, younger generations are a lot more hands-on, right? So there are generations that are used to being able to open up a finance app on their phone, just with a face scan or fingerprint ID. Their views on assets are very different. So they're not traditionally going to just be buying and holding some, low-cost index funds, although maybe they should do that. Many of them, they actually want to have tangible investments. They like things that are, investing in wines and NFTs and different alternative assets, prone to be experimental about things like buying real estate, right? There's so many things that I think that younger generations, when you think about how they invest their money, it's very different than, the past. So I think what we'll find is these are people who find new financial advisors, right? They're going to fire their parents' advisor or their grandparents' advisor. They'll find somebody new, and they want their money to be aligned with what's personally important to them. This is why their investments tend to look a lot different than, someone who's 20, 30, 40 years older than they are.
And you think we're entering an interesting era where financial advisors and custodians will be bringing investment management and cash management together? What's significant about that?
Yeah, well, I think look, when large banks start failing and people are panicking about these risks of a run on the bank, it definitely makes people start to question the way things have been done for 100+ years. And I think that today, what is really interesting is the benefit to some of that bank hysteria is that people started actually asking questions like, what else could I be doing with my money if I want it to be safe? And I think there's a few fundamental things, right? Banks they do have FDIC insurance up to $250,000, and people should understand that If they have that amount or less, there's not a high degree of risk. Like a bank is still extremely safe, but as people accumulate more assets, brokerage accounts, at places like Altruist Financial and others have FDIC sweep vehicles. They actually migrate the FDIC insurance through different partner banks. They oftentimes have $1 million or more of FDIC insurance. So you'll see more and more people actually using brokerage accounts to buy things like treasury securities directly from the US government, or, again, using these sort of partner bank programs. We've seen a huge explosion in just fintech companies that have bank alternative products that still offer a lot of FDIC insurance coverage. And many of them are exploding, right? Like they're just in a good way. They're seeing inflows that are just crazy. So people are paying a lot more attention. And I think that's not a good thing if you're a traditional brick and mortar bank paying 0.01% interest. That's not exciting to anybody. But if you're a young person who's paying attention and you're digitally savvy, you're going to be seeking out these better fintech-driven solutions, brokerage-driven solutions, things like that. They give you more insurance, bigger peace of mind, right? And they don't kind of come with like the negative connotation of like, grandpa's bank.
Right. Well, I mean, that's a great point that you make, Jason, because things are so digitally available. We didn't have this in 2008, 2009. If you want to compare different times of banking stress, it just moves so fast because of the digital distribution and scale that is afforded to us now. Anything else on the horizon with Altruist or its initiatives that you want to share?
Yeah, I mean, look, we're really excited. I mean, just like thinking about cash, right? So I think between now and the end of the year, date exact to be determined, we'll say, but we'll have things that I think will make the use of traditional banks largely irrelevant, meaning banking-like features, high degrees of FDIC insurance. So pretty excited about that. I think that's going to be really helpful for advisors and their clients, especially those who are like, feeling a little anxiety around things there. Continuing to evolve, the digital kind of platform that makes it easy for advisors to serve clients of all backgrounds. I think that's probably one of the most important things when we think about how do we make advice more broadly accessible. You need advisors to have better tools so they don't have to have these ridiculous minimums of like $1 million or more. What we've seen in the last couple of decades is like this huge divide between those who are wealthy and those who are not. That wealth gap keeps getting bigger and bigger and bigger. If advisors really want to make a difference and actually close that wealth gap, usually it's going to be because they reduce their minimums and they serve a more diverse background of clients, not just people who are already rich. So, we're really, really doubling down on tools that make advice more accessible so advisors can just, serve more people better without having to do tons of work. And hopefully that makes a really big impact on kind of that wealth gap closure. And also accessibility, so you don't have to go to, again, I love social media, but you shouldn't have to go there for all your advice. You should be able to go find an easy to talk to personal advisor that shares your same values, right? And they can help kind of be your guide. I think that's a bit more reliable than the average influencer out there.
All right. Appreciate the insight, Jason. Thanks for joining us on Trade Talks. I'm Jill Malantrino, Global Markets Reporter at Nasdaq.